So now we are on to the income tax provision process. All right, so let's talk a little bit about this income tax provision process. All right, so essentially what is going to happen is a company is going to compute two different components of its income tax provision, okay? And so you've got these two different components, all right? And as you might expect, you've got a current and a deferred, okay? And they get computed separately. And this happens for each category of income tax. So it happens for federal income tax, state income tax, local income tax, international, okay? And then all of those components get combined, and all of that together is their total income tax provision, okay? So if you want to think about it from a formula perspective, all right, here would be that formula. So your total income tax provision is equal to your current income tax expense or benefit, right, plus your deferred income tax expense or benefit, okay? And there are multiple steps to this process, and I am not sure why the seventh step got cut off. But so I will write the seventh step in here, and actually I'm going to change to a pen as opposed to, and so the seventh step is evaluate the need for an uncertain tax benefit reserve. Now, we are going to do some problems related to this process, but before we do, I want to talk a little bit about, and I'm going to move this up now. I want to talk a little bit about permanent book tax differences, okay? Because obviously we've got temporary and we've got permanent book tax differences, and I want to talk a little bit about permanent book tax differences. So I'm just going to change my colors a little bit, okay? So, so with permanent book tax differences, okay, so permanent, oops. Okay, so permanent book tax differences. All right, these do not get considered when we're computing your balance sheet deferred tax assets and liabilities. Do not affect okay. They enter into your computation of taxable income, and so they impact the current tax expense or benefit. All right, so they do impact your current tax expense or benefit, okay? And they usually, all right, affect a company's effective tax rate. All right, and so they're going to be part of the reconciliation between an effective tax rate and its statutory rate. All right, so they're usually going to matter when you're reconciling the effective tax rate to the statutory tax rate. And right now, this statutory rate is that 21%. So statutory just means of the law. And so your effective rate, right, is going to be different than your statutory rate. All right, so now let's talk about a couple of questions. I'm going to resize that just a little bit, so hopefully it's a little easier to see. All right, so let's look at this problem. So we've got Grand River, and they're reporting pre-tax book income of $660,000, okay? And included in that computation were favorable temporary differences, okay? And then unfavorable temporary differences. And then we also have favorable permanent differences, okay? And what it's asking us to compute is current income tax expense or benefit, all right? So in order to compute our current income tax expense or benefit, all right, our starting point is book income. Okay. Now, since we're looking at our current income tax expense or benefit, we need to look at our temporary differences as well as our permanent differences, okay? And so we have favorable temporary differences of $180,000. So since those are favorable, that means that our taxable income is going to be less. So those are going to decrease. So our favorable temporary differences, are 180,000. So minus favorable temp. Okay. And now we have unfavorable temporary differences. So those get added plus plus our unfavorable temporary differences, okay? And now we have favorable permanent differences. So if we have favorable permanent differences, we subtract our favorable and our permanent, and that is 176, okay? And now we're needing to compute our current income tax expense or benefit. So we multiply the result of that because this is going to give us our taxable income. And so that's times 21%. Okay? And so when we multiply that by 21%, we get 442 times 21%, which is equal to $92,820. And that is going to be tax expense. Okay. All right, so now we have a different type of deferred tax expense or benefit question, and I'll fill in the rest of the verbiage, but these slides are posted for you as well. So we've got Lynch Company, and they have a net deferred tax asset of $68,000 at the beginning of the year. I'm going to change to a highlighter. Representing a net taxable deductible difference of $200,000 taxed at 34%. So this is exactly the situation that happened when the Tax Cuts and Jobs Act went into effect. We had companies that had deferred tax assets on their books at one rate, and then that statutory rate was reduced to 21%. Okay, so during the year, they of course have activities, and they report pre-tax book income of $800,000, and they have favorable temporary differences of $20,000, unfavorable temporary differences of $50,000, and then at the beginning of the year, Congress reduced the corporate rate. So this is like what happened in 2018, at the beginning of 18. So they reduced the corporate rate, to 21%. And now what you need to find is Lynch's deferred income tax expense or benefit for the current year. So I'm going to move that up. Let's make that just a little bit smaller. So find their deferred income tax expense or benefit for the current year. All right, so now let's look at what we've got. And for me, I think the easiest way to do this is to kind of look at it from a T account approach. Okay, so what do we have at the beginning? Well, we have a net deferred tax asset of $68,000. So I'm going to do my T account right here. Okay, and so where does that $68,000 come from? So that $68,000 is equal to $200,000, all right? Our net taxable deductible difference times 34%. So that gives us our $68,000 essentially starting balance, all right, for our deferred tax asset at the beginning of the year. Okay, now during the year we've got some things happening, all right, but then also Congress reduces the corporate tax rate. So by reducing that corporate tax rate, all right, we know automatically that this balance has to change. Okay, and what did they reduce that corporate tax rate by? Well, so the new tax rate is 21%, but the old rate was 34%, so they reduced it by 13%. So if we multiply this 200,000 by 13%, we get 26,000, all right? Now, this 26,000 reduces our deferred tax asset, all right? So that is an adjustment to our deferred tax asset, and it adjusts it downward, all right? Now, what else is going on during the year? Well, we have pre-tax book income, and that's fine. But what really matters is we need to know the difference between our favorable temporary and unfavorable temporary. Okay, so I'm going to slide up just a bit. All right. And so our net deferred tax benefit for the current year is going to be equal to, and I'm going to move this up just a bit, is going to be equal to the difference between our favorable temporary differences and our unfavorable temporary differences. All right, so we've got $20,000 of favorable temporary minus $50,000 of unfavorable temporary, and that gives us $30,000, right? But remember, we have to, in order to find the deferred tax benefit, okay, we have to multiply that by 21%. And so our current year tax benefit is that 30,000 times 21%, and 30,000 times 21%. Now, you may be asking yourself, why was this a current year deferred tax benefit and not a current year expense? And the reason why that is a current year deferred tax benefit, right, is that our unfavorable temporary differences outweighed our favorable temporary differences. So what does that tell us? That tells us that in the future, those are going to reverse, and that is going to give us a tax benefit. All right? So that is why that is a tax benefit. And so that $6,300 is then going to be a positive adjustment into our deferred tax asset account. All right? And so what does the question ask us for? It asks us to find the deferred income tax expense or benefit for the current year. Okay? And so for the current year, we need this net adjustment amount. Okay? And so that net adjustment is 26 minus 6,300, which is going to be equal to $19,700. So let's come back up here and take a look at our, okay, and we can see that it is a net deferred tax expense of $19,700, again, because our credit to our T account outweighed our debit to our T account. And so that makes sense. Okay, so that is the answer to our question.